Ticker symbol MELI is up around 39% in the past year. And today we'll be looking at an international leader in a highly competitive market, which is a non-US stock. So this is a great video for those investors who want to look outside of the US to diversify their portfolio. Now this is an established firm which is growing at a very fast pace, and it has solid fundamentals, rising efficiency ratios, and its revenue grew by 40% in the past year. So today we'll be looking at Mercado Libre, an online marketplace company. In their annual report, they say that they're the largest online commerce ecosystem in Latin America, and this is based on unique visitors and orders processed. Now, this company facilitates digital and offline commercial transactions encompassing a range of e-commerce and financial services. So of course, the revenues can be broken into, first of all, their commerce, which consists of transactions on the marketplace and any related services, and then their fintech part, which is digital payment processing, providing credit for purchases, etc. Its growth strategy can be divided into three parts. The first one is that the platform aims to broaden its transactional offering, improve user experience, and grow its market presence even further across Latin America. Number two is that they want to focus on enhancing e-commerce payments, logistics technology, and expand into financial products. Now that part that we saw about fintech, which is the business with the highest margin possibility, they want to expand that even further to improve their bottom line. And number three is that they strive to maintain market leadership through organic growth, strategic acquisitions, and even leveraging synergies within its ecosystem. So they want to connect everything and use the customer data that they have in order to upsell and cross-sell their clients with all the different offerings. Now, one thing that you do have to consider here is that, yes, this company is already pretty established in Latin America. However, e-commerce businesses have a way lower penetration rate in that continent than in the US. So the growth potential for this company is a lot greater than it appears. But when we look at their financial analysis, it is amazing. They have a return on capital employed of 31%. Just so you have an idea, we usually look for return on capital employed above 15%, and this company has double that, which is great. Then they have an interest coverage ratio of 5 times, which is not on the high side. We usually look for companies with a 10 times. This value shows us the ability of the company to actually cover its interest in case anything goes wrong in the short term. But now when we move into their cash conversion, 89% of the cash that they get from operations is converted into free cash flow, which is great. Their profit margin is high at 48%, and their operating margin is an 8%, but because they're currently in the growth stage, and later on they say that they'll be focusing on improving this margin, especially by increasing the share of fintech revenue. Now this company's revenue is incredible. It has grown at 40% year over year, and it has grown every single quarter. Now, of course, its gross profit and its net income has also grown every single quarter. And one positive thing to detail here is that we can see how their net income has been increasing quarter after quarter by very small amounts, but extremely predictable and extremely consistent. Now, this is in line with what they want to do in the future. And when we look at their efficiency ratios, these also follow the storyline that they've been telling, where all of these have been improving and they're currently at very solid places. Their return on invested capital is just under 30%, which is a great place for it to be. And when we look at their leverage analysis, this company is using debt in order to funnel their growth. Their debt is higher than what I would want, however their total assets are still above their total liabilities, which is something great to see. And we can see that in the latest quarter, they actually decreased their debt while increasing their equity in order to improve their debt to equity ratio and appeal to more risk-averse investors, which I believe is a smart choice. Now when we look at their fundamental analysis, this company gets a solid 7 out of 8 ticks. The first one is that they have a low liability risk. Now they did have a 5 times interest coverage ratio. However, their net income is so predictable and they have so many short-term assets that they'll probably be okay in the short term. And of course, they have a very solid balance sheet because they can pay all of their short-term liabilities only by using their current assets. Now, this company is a monster at generating consistent cash flows, which is exactly what we're all about in this channel. And the good thing is that these cash flows are growing organically, mainly because their revenue is also growing organically. And by organically, we mean that they do not need acquisitions in order to grow. They do conduct some acquisitions, but it's not the main source of their growth. Now, this company has a very wide existing moat. Their services and their offerings may not be as strong as other competitors such as Amazon. However, they saw the opportunity in Latin America, which was an untapped market by these giants, and they decided to expand there. One main advantage from this is that Latin America has a population that is growing extremely fast, with countries such as Brazil and Mexico having huge populations. Mercado Libre has managed to establish distribution and logistics facilities all around the continent in order to lower their distribution price and to improve the experience. Now, they have an existing moat because operating in Latin America is very different than than operating in the rest of the world. Customer preferences are extremely different, the way they purchase their goods, the services they need, and these customers are extremely loyal. These differences in operating between continents, I believe, is one of the main reasons why Mercado Libre is currently safe from Amazon. But the best part is that it is currently increasing their pricing power by introducing their fintech offerings. Of course, here, their margins are higher, but because the value offered by these services is a lot higher as well. Allowing sellers on their platform to use their payment processing services, allowing buyers to take on credit in order to finance their purchases, and other services like these are first of all allowing them to increase their average revenue per user, which is one of the most important metrics in these sort of businesses, but they're also providing a lot more value to their ecosystem. Another part of their existing moat is that Mercado Libre has managed to partner up with some of the biggest companies in Latin America, and these partnerships are part of the reason why Mercado Libre is managing to grow at these rates. Now, well, the one thing that this company didn't get a tick on is their dividends and their share buybacks. They're not paying any dividends and they're not currently buying back their shares. However, I don't see this as a negative point because this company is in its growth stage. So I prefer that this company is using their free cash flow in order to reinvest it back into the business rather than distribute it out to shareholders or buying back their shares. And when we look at their valuation analysis, I believe that it will be extremely difficult to find this company trading at lower valuations because of their fast growth rate and their high perceived quality by the market. They currently have a price to earnings ratio of 72 times, which may seem high, but when you remember that their revenue grew at a 40% last year and that their margins are increasing quarter after quarter, it makes a lot more sense. Now, they currently have a 3.26% free cash flow yield, which is above their 3% long-term inflation rate, which may imply that this company is trading at around fair value. Now, some of the risk and possible challenges that I do see is first of all the worsening of the competitive landscape, and this is because Latin America is a largely untapped market by other huge competitors, and other companies like Amazon, eBay, or AliExpress may start to heavily invest in this market in order to capture some share. And the second risk that I do see is them not meeting performance objectives, and I am overstating this risk. But in their annual report, they don't mention that they want to expand outside Latin America. Of course, they have been performing great in this continent, but they're already very big. And when they've entered every single country, and every household knows their name, they should be looking for growth outside Latin America. The fact that they're not analyzing this currently does raise some uncertainty for me whether this growth can be sustained in the long term. It is very good that they're introducing new services and new products, but I do want to hear management speak about their expansion opportunities. Now, before we move on, please remember that I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I believe that this company has a great competitive advantage. It is producing extremely consistent and predictable cash flows, and it has a very high return on capital employed, so it means that it knows how to create value for the investor. So I do believe that this is a good company and it will probably be a great investment, especially if you can buy it at a better valuation. So thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic.